Good morning, everyone. Welcome to IB Europe State of the Nation. We will give everyone about 30 seconds to connect. We can already see we've got lots of people joining from all across Europe, so welcome. Okay, the numbers are increasingly going up, Daniel, so you've got a very captive audience all wanting to know what's going to be happening. Okay, let's kick off so we won't delay any more time and we can save lots of great questions for Daniel at the end. So yes, welcome to this morning's State of the Nation, our digital advertising special edition. My name is Helen Muzzard and I'm the CMO for IB Europe. I'm delighted to be today's host. And just before I shortly introduce our brilliant and insightful speaker, Daniel Knapp, our Chief Economist, I just wanted to say that we are live today. So after Daniel's presentation, we'd love to take as many questions from you as possible. You'll see at the bottom of your screen, there's a chat box, so please do put your questions in there, or there's also the Q&A box, which is probably more appropriate, so you can put that in there as well. Daniel, I'm going to pass over to you because I know that you've got lots to get through and take it from there. Thanks so much.
Thank you very much, Helen, and good day, good morning, everybody. I'm looking forward to discussing the ad spend outlook into uncertain times. We've just yesterday finished our forecast revision, given both the cyclical effects from the economy and also the structural headwinds that we're facing as an industry. This is, in a sense, a work in progress, as the situation is highly dynamic. But we wanted to put a stake in the ground and say, what is the status right now, and how can we best prepare for the times ahead? Because the kind of post-COVID party does seem to be over. We are entering indeed into uncertain times, and I think nothing illustrates this as well as this wonderful picture from Looney Tunes, where the coyote trying to chase the roadrunner. When he falls off the cliff, he doesn't fall down immediately. He defies gravity. Only when he looks down in the cartoon, he falls. The question is, should we dare looking down as an industry? We came out of the pandemic, out of 2020 and 2021, with a massive, in a sense, confidence boost. You recall that we had over 6% of digital ad growth in 2020. And 30.5% in 2021 for all of Europe. And most markets were in the kind of mid-20s or high 20s range. There wasn't a single market that did not grow double-digit. But this post-pandemic confidence is waning very quickly. And we are not daring to look down as the coyote does, because 2022 and what's coming are providing some material headwinds for our industry that we do need indeed to brace for. I think what's really new is that we do not have a just plain economic crisis. We do not have the already complex pandemic situation where economic, epidemiological, and policy choices were all kind of as a combined force impinging on ad spend. We have what the economic historian Adam Tooze calls a polycrisis. The German term for this concoction of errors here is Krisenbilder, or crisis pictures, and it shows mutual dependencies and amplifications of various factors, which all make the economic situation that we're in hugely complex. And each of these can be a lever to affect different parts of the real economy, and with that then also downstream the ad economy. What we also have marked in red here are so-called macroscopic events, meaning a combination of any of these in themselves large events could trigger something even larger, which would mean that the economy is going to fall off a cliff. And this, of course, makes the job of forecasting much more difficult. We have singular trigger events which might eradicate all forecasts, and we have an extremely complex combination of facts where the typical GDP correlations that we've used in the past are not really applicable anymore. So how can we navigate this space that's unfolding currently? The latest IMF forecasts came out just a couple of days ago, And the news here is, from a GDP perspective, the worst is yet to come. We're looking here at GDP growth in constant prices for the world, the EU, the UK, and the US. I exclude the Eurozone here, just primarily due to legibility. The Eurozone faring slightly worse than the European Union. This is in real terms, so in a sense here, inflation intentionally not baked in. What we can see, of course, is that massive crash in 2020, the rebound, but now things are weakening, and we can see in particular the EU and the UK is going to be much more severely affected than the rest of the world, and also some other advanced economies like the US. Of course, in the UK, we got the double whammy of general economic weakness, the war in Ukraine, or triple whammy, the war in Ukraine, etc., but then also the domestic issues in the country. But in the EU and in the Eurozone, we're also seeing a massive slowdown to what is here 0.6% GDP growth in constant prices in 2023. And what we all know when we recall past ad recessions, there's this magic threshold of around 1% or 1.5% GDP. If real growth drops below that rate, ad spend is typically going negative. So we have to brace for something. And we can see, yes, a recovery currently predicted in 2024, but it's a slow recovery. And we have to see whether that forecast really holds, as the IMF and other economic institutes have been constantly revising downwards economic forecast, and also extending the horizon of the crisis from initially when the war started in Ukraine. I think the April update of the IMF still predicted at around a contained 6-month period of the war, and then things will go back to normal. Of course, that horizon has now extended tremendously with no clear end in sight. So I expect that the 2024 forecast will also be revised downwards in the next iteration. For us as an ad industry, that begs a key question. Well, haven't we escaped that GDP ad spend amplification effect? Hasn't COVID shown us that the correlation broke down? Haven't we grown, particularly as a digital ad industry, despite the economy going negative? Well, let's take a step back. What we can see here is ad spend growth and GDP growth in real terms in the US. I picked the US here because we have the longest time horizon of ad spend data available here, courtesy of Bob Cohen, the godfather of ad forecasting. And what we can typically see is that during times of economic crisis, there is, just to recall for everybody, an amplification effect, i.e., when the economy goes down, ad spend typically goes down by orders of 2.5, 2.7x, or even 3x. This has happened in past recessions, and I think it's pretty clear if you look, in the beginning of the 90s, if you look at the dot-com crash in the early 2000s, it's clearly visible. Lehman crisis, you can see it as well. And then, of course, here it's US, so the Eurozone crisis in 2012 is out. But what you can see remarkably in 2020 is that the economy didn't decline, or ad spend didn't decline more than the economy, but it was in line. So we thought, well, maybe this correlation is now broken. Maybe there are endemic forces in the ad industry, the rush towards digitization, the rise of SME spending, people spending more time online, which actually lifted up ad spend as the structural transformation of the economy towards a more digital economy was kind of balancing out some of the cyclical effects that we've seen. So can we bank on this again, or can we not escape this amplification effect? Unfortunately, I don't think we can escape it. And let's look at a couple of reasons why. And this is predominantly because the era of cheap money that has fueled a lot of VC spending in D2C brands, that has fueled lots of ad growth to grow market share, etc., that period is over. On the left, you can see one of my all-time favorite charts, a 5,000-year history of interest rates, which shows that, until about a year ago, there's never been as cheap in history to borrow money. But this is changing radically right now. So if we look at recent World Bank data on the right side, we can see how many central banks were actually issuing rises and cuts in number. And we can see that the central banks who were issuing cuts in interest rates globally diminished to close to nothing. And we have a peak period since the 1970s, not have heard, where in unison, in a sense, central banks were rising interest rates. So this means that period is over. That also means that money needs to work different. So there's, in a sense, less oxygen available for digital ads because companies can't just grow at all costs. They need to turn profitable. And that means reduced spending available. We can also see that the SME spending, which fueled so much of 2020 and 2021 growth, has, in a sense, reached natural limits. What do I mean by natural limits? Well, let's first look at here in Europe how strongly, as a digital ad economy, we're exposed to small and medium-sized enterprises spending. A comparison here on the very left, you can see the typical share of major marketers, the Fortune 500, the brand marketers, how much they spend on digital in the broadest sense versus other media. You can clearly see here a TV overexposure implied in those numbers. But then flip to the middle and you can see how reliant small and medium-sized businesses are on digital spend, with over 70% of their spend being digital. Some that came into the market maybe for the first time during the pandemic are 100% digital. And then on the very right side, you can see even more so that when you look at search and social spend, the share that comes from SMEs/SMBs. So this isn't the total direct spend that these companies enjoy, the sector enjoys, but the money coming from SMEs. It's hard to calculate as we don't know the exact numbers of the long tail of companies advertising on those platforms. We have broad ranges of the number of advertisers, but the makeup of these SMEs is very, very hard to grasp. Regardless of that, if we take this as the basis, right, this heavy exposure to SMEs, what has happened? SMEs have digitized, in a sense, overnight during the pandemic, and of course upped the digital ad spend. But they've reached limits in terms of how many new customers they acquire, how many more customers they can upsell. E-commerce, I'll come to that in a second, isn't growing anymore. Ad prices have gone up. Measurement attribution has gone down. We see the Apple ATT effect kicking in. So there are natural limits now that SMEs can spend. It's not anymore as it was 2 years or even a year ago. So we shouldn't really bank on SMEs as the underwriters of the digital ad economy in the next years. And as we all know, the world hasn't entirely changed. There's also less oxygen for digital ad growth because the world has become more physical again. And I think nothing illustrates this as clearly as taking the quintessential pandemic stock, Zoom, and map its growth over the trajectory of airport passenger numbers. And I took Heathrow here as an example. Clearly, correlation isn't causation. Regardless, this chart, I think, illustrates very clearly that as the world returned more to a more physical world, we've seen pressure on digital business models and also just less time available for people to stay online. This is impacting our digital ad market as well. And that often proclaimed mantra, 4 years of growth in 3 months, is being radically corrected, and we see a regression to the mean. What you can see here from the Office of National Statistics in the UK is the percentage of overall retail sales which are conducted online. And this was a fairly linear growth with some seasonal peaks going on until we saw, of course, this exponential growth, which we as an industry celebrated 2 years ago, 1 year ago, and expected, in a sense, to have this tremendous leap, this exponential growth towards an e-commerce first world. Now, things are correcting rapidly, and you can see that this was a blip and not a long-term trend. And then if we fast forward and see what does that actually mean to overall e-commerce spend growth in Europe, we took figures here from Eurostat, created by Statista. I always take Statista numbers with a grain of salt, but these were kind of Eurostat numbers. We looked at the past Statista forecast, and we did our own forecast for e-commerce growth. And we can see, of course, between January and October 22, a significant correction of the growth curve, where we're seeing, in a sense, if we put numbers behind this, a 108 billion euro loss in overall e-commerce spend until, in a sense, the end of 2023. And of course, if that market opportunity is shrinking, it also means there's less space for ads available to support it. Now, the good news here is that regardless of this kind of correction of e-commerce growth, the pandemic has indeed brought forward overall consumer adoption of considering e-commerce as a way of shopping. They might not be spending more, but there are more consumers in Europe who are now considering using e-commerce models. What you can see here again from Eurostat is the number of people, so-called e-shoppers, who have done a purchase on the internet within the last 12 months. This has been growing continuously until you saw a major growth in 2020, slight correction already in 2021 as the world became more physical. But the good news is the 2022 expected share from Eurostat is again a slight growth. So at least we have this foundation available. And it means that although we saw the correction towards the mean in terms of e-commerce growth, it means we now as an industry have a solid foundation, infrastructure, payment services, ad models, etc., which allow us to better capitalize on e-commerce adoption in the future from an ad industry perspective. So not all is lost in a sense. We can probably capitalize on future growth in a much better way, but it's currently just not there. So are we really then, with all of this considered, in an ad recession, and primarily an economically induced one due to low economic growth, high inflation, and so forth? Well, the current picture isn't that clear. So I grouped the companies here in two buckets for sake of simplicity, called one big tech and the other agencies. For the tech companies, platforms, however you want to call them, I took their ad revenue only, whereas for agencies, I took their total revenue. So media buying, PR, other services, data, and so forth. And what you can, of course, very clearly see is not only a relative slowdown on the left side here, in the left bucket, where Q2 was far more muted in terms of growth than Q1. This is always year over year, so always versus the same period in 2021, with Meta even negative growth, Twitter single digit, Google growth kind of half versus the previous quarter, Snap also nearly kind of 2/3 down. Then flip over to the agencies on the right side, and not only can you see that growth rates are often higher than on the left side, but also the growth rates are actually have increased from the first to the second quarter. So what is happening here? With very different press narratives as well. On the one hand, hiring freezes, bracing for recession, ad spend slowing significantly, and others, at least a couple of months ago, still issuing statements to increase guidance, etc. Now, many factors are at play here, but of course, you can add things together when you look at the waning SME spend that I mentioned, that VC money sits much tighter now. The effect of ATT is already baked in here. And of course, on the agency side, we've got very, very different clients. We got larger companies that often are not extremely sales driven and more marketing driven, so slower revisions towards budgets, not as tactical switch on, switch off nature, and also longer upfront commitments. Meaning, of course, the picture that we're seeing here on the right side is not necessarily going to translate into something very similar into Q4, and we can already see that Q4 and Q1 23 is going to be tough. But the key message here is, from how the situation is right now, it is not primarily an economy-induced slowdown. There are structural factors in the ad industry currently at play, which obscure the economic trends and even have a stronger, at least in the moment, impact on who spends, where they spend, and how much they spend. It is not a simple doom and gloom scenario currently. There are 5 concurrent trends which do cloud the picture. Number one, we got from Q2 results, mixed signals. Some companies or some sectors doing extremely well, like travel. We're seeing automotive already cutting back, for instance. I mentioned the distinction between marketing-led and sales-led organizations. I also highlighted we see this massive divergence between tech and agencies. Upfront commitments, we have to monitor what's going on there. So what are renewal rates? What are commitments for 2023? Ubiquity published a study a couple of days ago looking at what large advertisers, so primarily those working with agencies, are doing. The picture here isn't as pessimistic as some of the platform results might imply, where we see a large proportion of advertisers either maintaining or even slightly increasing spend. So this is still very much in play. The e-commerce slowdown, I think, is really overlaying over the cyclical factors in the economy. ATT, signal loss, etc., a huge issue, also affecting ad spend. And then lastly, I think we have to see as a positive for Europe at least, and for the US, as the Chinese domestic market with the housing crisis there is weakening, as container shipment costs dropped from $19,000 to around $2,000, $2,500 to get a container from Shanghai to Antwerp. The overseas markets are extremely attractive for Chinese advertisers who spend massively, primarily on Amazon and other self-serve platforms. So not a simple doom and gloom. But what can we do to, in a sense, codify this? What tools do we have available to make predictions? There are a couple. You already saw that I looked at the GDP ad spend correlation. That's a typical way of doing it. It's the kind of top line model, macro modeling. This is some really, really good pros. So it's a well-established approach. We know this amplification effect is there. COVID just partially paused it. It didn't eliminate the correlation, but there are some cons as well, meaning there are only so many economic indicators that we can look at, and they're typically lagging a lot, right? The IMF is publishing, used to publish twice a year, now maybe a bit more often, but it's lagging. At the same time, when we have few variables available, they don't really pay respect to the number of factors currently at play in the poly crisis that are outlined at the beginning of the presentation. So the reality is much more complex than a very simple economic model can handle. What else do we have in the toolbox? We could build a sectoral impact model, which is something that equity analysts often do, that look at specific company performances. So if they look at a company, be it a Meta, be it an Alphabet, etc., they typically look at the advertiser composition and group advertisers into types, and then you try to understand the sectoral exposure to economic trends that each of these each of these groups of advertisers have, and then kind of, in a sense, try to read through what impact that will have on spending for a specific company. Some pros as well. It captures really the advertiser strategies. It's something that acknowledges that different sectors have different approaches in an economic downturn, and different companies have the same. So it's pretty well suited for a specific company impact model. However, industry-wide sector data, apart from anecdotal evidence, is really hard to obtain. In particular, if you want to stretch this out across countries, right? If you look at some Nielsen or Comscore data, often what we have available in terms of spend is not really harmonized across countries. So what falls in the FMCG or the CPG bucket, what falls in another bucket, and so forth, it's hard to stitch this together. And also, as we know, we have this high exposure to SMEs, which kind of escape the sectoral impact model, because these millions of advertisers, do we really know which sectors that they're in? Do we know how they react to a downturn? The model comes to its limits here. And it also assumes that typically advertisers of a given sector behave in exactly the same way. And we know that this isn't necessarily true. When we look back at Unilever versus Mondelez strategy, for instance, during 2020, one was increasing spend, the other was slashing spend, although they are broadly in the same categories, differing in terms of ice cream and so forth, but broadly FMCG. So if you kind of cast your buckets too wide and don't understand company-wide nuances, you might also miss something. We have a third tool, of course, industry surveys and expert interviews, something that we often do at IB Europe. So we're asking people, experts, buyers, what they think about the crisis. So this gives us access, of course, to industry executives and off-the-record insights. We can execute this fairly quickly in the survey, so we're not really reliant on these lagging macro indicators. It's also fairly concrete, less abstract. We get more context, etc. It works best if we can standardize this and build this as an index over time, asking the same questions again, like a bellwether, for instance. But to be of predictive power for advertising, it needs more granularity than a typical purchasing manager bellwether index, for instance, which lumps all sectors together. There are problems, though. There's buy-ins from the respondent selection. Whom are you asking? How are you wording your question? And also, how do you retranslate the individual responses into quantitative model, right? Do you treat every answer the same? Do you expect everybody to have the same access to the market? Do you emphasize certain opinions over others? So this also hinders us in producing accurate forecasting. And lastly, of course, we got also highly lagging analysis of the financial finding, SEC filings, other quarterly reports, and so forth. Luckily, here we have, at least for large companies, make around 70–80% of overall ad revenue, highly accurate data. We know how big the long tail is. We know exactly the revenue. We need to split it into European regions, other regions, and so forth. Investor calls give additional color, but can also be highly evasive. And it's very, very slow. It's very selective. And we have a lack of detail on the individual markets. So if questions aren't asked in the conference calls, we can't really have a comprehensive assessment model for all the markets under study. And in our ADEX study in Europe, as you know, we have 28 different markets. We're never going to get insights into all of those, or even a fraction of those, in company earnings calls. So the bottom line is we need to use all of these different tools in order to assess the impact. To date, in my forecasts, I have drawn on macro modeling, industry surveys, and also analysis of financial filings. We want to get to a sectoral impact model. This is a work in progress. And the next release of the forecasts will be done in December with a refresh of all of these 4 methods combined. So how do things look like currently? We made a downward revision of our forecasts. So in May 2022, during our Interact conference, I was still confident for a 10.1% growth for digital advertising in 2022. And I've since corrected this down to 7.1%. This week, we've crunched the data to understand how does 2023 shape up. Previously, I had a 5.5% forecast, so 7.1 versus 5.5. There was just a slight slowdown between those years. But what we can see now is that key categories in digital advertising, primarily social, which was a key driver, is performing fairly poorly. And I'm now expecting actually some formats to post negative growth, and overall digital advertising in Europe to go out of 2023 with a 2.4% growth. The total market, including other media, will then decline by around 4%. If you do the math, assuming digital is around 60–63% of the overall market right now, that gives you, depending on definition, what you include, what you don't include, where you put AVOD, where you put linear TV, etc., a decline for traditional media of between 13 and 16%. Although some will fare better, in particular out of home, which is still coming kind of out of the after the lockdowns, high kind of just organic growth, rebound after the pandemic, and we believe it has continued growth potential over the next 2 years. But other media will be severely affected. We are still, until the IMF changes its outlook, we are maintaining a 2024 recovery, but that may change. Let's bring a little bit more color onto those numbers and see how the different categories in digital ads are actually performing. And here is a first assessment of that. And you can see not every channel is affected equally by the recession. We can see clear winner in this here is the retail media category, which in 2022 will continue to post high double-digit growth, and also in 2023. Retail media for us is ads bought on the sites and apps of retailers who typically, but don't have to, sell the product that they're advertising, and retailers also buying media off-site on behalf of their clients. Search is making a renaissance. It slowed down in 2020, strong rebound in 2021, and we as an established performance medium think it's going to grow now stronger than social, for instance. And this is kind of the key bit here. Of course, you see audio, a nascent format, yes, growing, but significant correction as it's, experimental budget still often. So money is being put where we can measure the impact immediately. Video still through TikTok, potentially with a Netflix launch, etc., has some legs. But the important thing here, which kind of tips the scales, is social. We're seeing a significant slowdown in social media ad spend as the user market is saturated, ad rates are saturated, and we can also see with ATT measurement or signal loss is impacting the performance of those ads. So we're currently in Europe, based on Meta and other results, seeing, of course, growth in TikTok, but even with that, only a 3% growth for social in 2022, and actually only a 1% growth in 2023. It's interesting when you look at the recent Magna Global forecasts for the US, which came out recently. They have around 4% in social for the US in 2022, and then a slight increase again in 2023. But the macro situation in Europe is quite different, so that we cannot assume that social is going to grow stronger in 2023. So it's not in Europe going to enjoy the kind of 2023 rebound after a right sizing in 2022 after overspending the pandemic. Here we're going to see really the cyclical economic factors hitting home. Display, including social, and also down outside of social, it's probably going to be, as we can see here, currently 5%, and this is actually with video blended in, so the banner part is going to suffer more. Classifieds and directories, as consumer wallets are tightening, is also going to decline. This is how we currently see the market, based on economic modeling, based on interviews, and also based on SEC filings. But this is a work in progress, and there are revisions likely. Now, as I mentioned, it's not all doom and gloom, though. And I think in particular, we can see the combination of crisis, of cyclical and structural factors also breeds innovation, breeds something new. And I think there's an analogy here between the current rise of retail media and the rise of search during the Lehman crisis. Both are crisis kids. And what I've done here is I have, in a sense, established a year zero for each, the year where they both start to grow exponentially. And for search, that was 2008 during the Lehman crisis, and then of course with an 2009 massive surge. And for retail media, it was 2020, the first year of the pandemic, as we all moved to online shopping. So we have the revenues here. Of course, search, the search revenues here are in their year zero, are in an ad market which was much less digital than it is today. So it doesn't mean that retail media is nearly as relatively speaking as big as search yet. But I think what we can clearly see is that both of these were growing extremely strongly during or just right after this year zero in the 5-6 years that followed it. And year 6 here for me is 2026. That's why I picked it. It's the end of our forecasting period, and we can see that retail media is growing strongly here. Some are concerned that with the rise of retail media, there is, on top of the economic downturn, a budget migration, i.e. budgets moving away from publishers to retailers. We are currently not seeing that. We're currently seeing this as being fairly distinct markets, where retail money is coming in Europe primarily on 80%, still coming from trade budgets, i.e. offline trade budgets, which are being put online, shopper media budgets, and so forth. And then we see a migration more from search and social budgets, not from display programmatic spend on publishers. And indeed, if we look at all the changes happening in the targeting identity landscape, there are huge benefits of publishers and retailers working together, particularly as retail media is currently primarily focused in the lower funnel and want to get to the upper funnel. And here, building partnerships with publishers in Europe can be incredibly useful. as very few players can achieve what an Amazon does, in a sense, buying TV rights, buying TV channels, to have this kind of full funnel approach from awareness to conversion. So partnerships here are imperative, and this would be my call to action for everybody in these uncertain times, to not stop forging strategic alliances and to enable Europe Inc. or the European industry to go together through better partnerships. With that, I'm going to stop. The next update is going to come in December with more clarity on how 2022 is going to shape up, and also we're going to have better readings on 2023 as the first budget commitments will have come in. Helen, let's open the floor for questions, and let's see what we can see.
Okay, perfect. So we've got a couple of questions that have come in. Before I go to those, just because I can imagine everyone's head is feeling very similar to mine, in the sense that we're taking in so many stats, and there's going to be lots of people trying to calculate exactly what this means. And maybe people need just a reminder of some of those key stats. So Daniel, can you, just going back, looking at the decline, you said you're expecting for 2023 a 4% decline for ad growth. Majority of this is going to be fueled by social, is it correct that it's a 16% decline for traditional media? Can you just clarify a couple of those stats again?
Absolutely. Let's go back to these stats here. So total digital growth here refers to everything that we capture in our AdX study, plus retail media, which we hadn't fully captured previously. So I deduplicated those numbers and put it all together into a new digital total, and that gives us a 2.4% growth for digital advertising. This digital also includes the AVOD services of broadcasters and the digital propositions of print media, etc. All media here, this is all media together. So anything that's digital, anything that is analog.
It's the total ad, yeah.
That is total advertising, correctly. And for traditional media, if we just subtract this, right, the total size of the ad market minus the total size of the digital market, and then run growth, it would be around between 13 and 16% decline for traditional media. Not being exactly precise here, because different forecasters categorize media differently. So depending on whose source data for traditional media you take, you'll have slight variations in the impact. But it is really not, and I want to emphasize this again, it's not a traditional versus digital growth. We did have that during the pandemic, but that is not the case. We can see that there is, there are now limits to overall digital ad growth, and we see some categories in other media, and I mentioned out of home, including of course digital out of home, which is performing fairly strongly, and which will not see that 13 or 16% decline.
Okay, brilliant. Just a question here. So I think you may have elucidated it when you talked about the SME kind of slowdown, but why are we going to see lower growth in 2023 for social? Is this purely from SME kind of slowdown spend?
Not purely from SMEs, but we have to see that SMEs are the main advertisers in social. Yes, we got big brands there, sometimes even D2C brands, which make up the, let's say, a limited amount of time, a large proportion of being the top advertiser. I remember the fuel supplement brand Huel for a couple of months in 2019 being the largest advertiser on Facebook in the UK, for instance. So D2C brands and SMEs. The SME slowdown is having a significant effect on social, but we're also seeing user numbers not growing anymore because it is saturated. We're seeing time being split more between platforms. Time isn't additive anymore. And of course, we are having signal loss currently still with Apple ATT, which makes advertising potentially for some categories, particularly in the performance segment, more expensive and less accountable. So this is impacting social growth, and it's historic in a sense, because it was always social that was outpacing the market for the last decade or so.
Okay, and then actually just I'm going to skip one question, go back to it while we're on the subject of social. Someone's asking, is social one of the key drivers of the decline in growth in 2024? Are there any countries within Europe which is contributing more than its fair share in that decline?
Well, just because of the sheer size of social, with over 50% of digital ads, the in a sense, flat growth in social has a major drag, of course. But we could see that other formats, I think other kind of open market display formats and so forth, in my view, will take a larger hit in net terms, but their relative weight isn't as strong as social. In terms of countries in Europe, I think it's remarkable. What is partly driving this, of course, let's go back to our AdX data. We know we have 28 countries in there, but over 50% of spend is coming from 2 countries. It's coming from the UK and it's coming from Germany. And the UK fared extremely well in the pandemic in terms of ad spend, massive growth. But now also with the domestic issues there and inflation, etc., we're going to see a more muted outlook for the UK, which has a drag down effect on the rest of the market. I think Germany will also be more affected than some are still believing. In particular, as Germany is highly reliant on the Mittelstand. It's not small businesses, sometimes even not medium, but medium largish businesses, which are typically privately owned, were suffering from extremely high energy prices, and those will suffer in terms of growth and also digital advertising. We're of course seeing now in Eastern Europe the close proximity to the theater of war is having an impact. IB Ukraine recently published kind of H1 data for 2022 with an over 50% decline in the market, improving position right now. So these are some of the factors, right? And I think in the overall European numbers, we'll break out in the next iteration the by country numbers. The effect of these very large markets, the 2, 3, 4, 5 top markets, is going to have a huge drag down. And let's not forget, Russia is in those numbers as well.
Yeah, and I think when you're looking at the overall, you're exactly right. It is very hard sometimes to see that we've got this huge amount of social, these huge 2 countries. So actually, it looks quite shocking at the stats, but actually breaking it down on a country by basis or a channel basis can say different stories. And I knew we're going to get lots of questions on CTV because you hadn't kind of mentioned that in the presentation. I know that you're probably going to save that now, or do we actually have the information on that? So someone's asking, do you foresee growth in digital addressable TV, CTV inventory? I think that's always a big question. And will consumption and offsetting any of these trends for 2023?
It's an interesting question. So we're still doing our CTV model for Europe. We only have in our AdX study 3 countries, 3 national IABs, which are providing CTV figures. And we don't expect this to change significantly in the next couple of years, mainly as all countries are defining what CTV is extremely differently. So we need to build, in a sense, our own model of CTV based on an IB Europe definition, remove CTV spend from those countries who declare it, and build our own. We haven't done that yet, so that's why I'm not breaking it out, as I'm basing my forecasts here on what we have available in AdX. We are going to see, I think, continued growth in CTV. I don't expect CTV to drop, and you've seen some of it is baked into the video numbers. So growth is going to continue there, but the market is, of course, far smaller than in the US. So it doesn't really have, it's so small. I think in the UK now it's around, I think Spark 90, the consultancy, released this new data recently, around £900 million, which is not very much at all in the grander scheme of things. And the UK probably has around 2/3 at least of the CTV market share in that definition. So even if CTV was growing triple digit, it wouldn't be able to offset the downward trends in other channels.
Okay, so on staying on that, this one question is about pricing. I don't know whether you can offer any insight into this. So it's looking at CTV video pricing in 2023. And they said that Disney and Netflix are launching ad tiers. Every platform is pushing short form video, and YouTube is upping its ad load. What's your predictions on pricing? Or do you have any?
No. Well, we know some of the pricing, right? We know the Netflix pricing over the 60 pounds, 60 pound CPM, very high, very limited reporting. Let's see whether they can really push that through in the market. I think we are in particular where kind of CTV and linear TV is being bundled together. We're going to see some pressure on prices, but I haven't looked into CTV pricing in detail.
Okay, this just before we go to this next one, this is just about looking at the difference in ad spend between advertisers with bricks and mortar sides to the businesses given the right, with energy costs. Just want to ask a couple of questions on retail media, Daniel, because you've clearly picked out this and as a winner in terms of kind of growth and maybe towards recovery for 2024. News you've probably seen in the UK, M&S announced the closure, I think, of about 60 stores. They're obviously moving much more into e-commerce. Or in your presentation, you said that e-commerce is kind of, maybe not as big as we've previously seen. There isn't that big of an opportunity. Do you think with more retailers like M&S making this adjustment and moving more into e-commerce, and as this person said, we've got the rise of variable cost energy, so that is going to make more businesses go more digital only. Will that kind of shift help to fuel e-commerce, and then in turn will that help to fuel retail media, because then they become retail media players themselves?
Well, the e-commerce growth really depends on the consumer wallet and not so much on how many more businesses are digitizing. We already have, across Europe, a fantastically digital grocery ordering and delivery landscape. But of course, for the economics of some of those companies, it might be beneficial. And we also know, grocery delivery by itself often is not profitable for many supermarkets. It's actually a loss-making business. But retail media is attractive here because it has extremely high margins, between 60 and 80%. They're a bit higher, of course, on-site versus off-site, due to the additional cost that you have in terms of off-site. But this is becoming really attractive, I think. But one thing I want to say is that the e-commerce slowdown does not imply a retail media slowdown per se. We are seeing that despite the e-commerce slowdown, retail media is growing several times faster than e-commerce gross merchandise value, i.e., how many goods are actually being transacted. Retailers typically today in Europe are, the size of the retail media business, at around 1% of online gross merchandise value, some a little bit higher. And the kind of landing zone or the consensus is to reach 3 to 4% within the next 5 years. Some want to do it even faster, which means that retail media is going to grow faster than overall e-commerce transactions anyways. I think the risk for retail media, despite its huge opportunity, is that can retailers really deliver on its promise? Number one, inventory on retailer sites and apps is limited. Not everybody will want to increase the ad load as much as an Amazon to turn in a sense ads into a toll road, a tax, a pay-to-play business. It impacts the user experience as well. It's currently still growing because we're seeing more and more retailers coming into the market. But the real opportunity of future growth in the next couple of years will be offsite, i.e., using retailers' elusive first-party data to buy ads elsewhere on the web and hopefully drive people back to the store for conversions, but also use that across the funnel. But of course, it means that retailers need to build up their teams. They need to build expertise in programmatic, in areas that they are not so familiar with yet. They might need the help of agencies and other specialists. And if hiring freezes are coming, that makes it hard for retailers to seize this opportunity.
Okay, so just to go back to that point that you say about offsetting, and that was actually going to be one of my questions too, about what does this, we're saying this fantastic opportunity for retail media. What is the knock-on effect of publishers, the traditional publishers out there? But you're saying you do think that will be supported by this offsetting that will naturally have to come because of the availability, the lack of first-party data, all of those kind of talent, expertise.
Yeah, so I think you're referring to the relationship between retail media growth and kind of publisher advertising growth. I just want to reiterate, we're not seeing budget cannibalization from the likes of news publishers to retail media cannibalizing news publishers. These are different pools of budgets. These are different people making decisions with different marketing objectives. It is still separate. Having said that, if publishers can provide first-party data, if publishers can provide compelling attention metrics and kind of merge their data in whatever way with that of a retailer, it provides for the promise of retail media and thereby indirectly for publishers as well a huge opportunity, because with retailer and publisher data, the retail-centric advertisers can address more of the marketing funnel.
Okay, and just a question here about staying on this theme. What is your suggestion on investing in digital advertising in 2023 versus 2022?
It depends, I think, for every brand. There isn't a blanket recommendation. I think that one of the key benefits of digital in terms of economic uncertainty is the switch on, switch off nature. You can move extremely tactically, adapt to situations, and when it comes to price promotions, for instance, this is going to be, I think, a key for many, particularly in the FMCG space, also e-commerce space, in 2023. But then also for brand advertising, if consumer wallets are squeezing, it's always a good time to invest in increasing your share of voice in terms of making your brand, increasing the kind of tapping into consumers' mental availability and situating your brand there. But there isn't a one size fits all recession playbook. It very much depends on the brand. Overall, and this is unfortunate, of course, we are entering, of course, the final stretch as the agenda stands today of third-party cookies being phased out. And when marketing spend is being cut, when all eyes are on the current quarter, on the political and the economic situation, both headspace and financial availability to invest in extremely urgent structural reforms is often not there. We've seen this, Helen, in our study recently from IB Europe about advertisers' use of first-party data.
Yeah.
Where we saw that the priority of first-party data actually started down in favor of second-party data. And in recent conversations have just reiterated that many are adopting still a wait-and-see approach. And this means that even if the recession is over, we cannot just resume business as usual. And if we don't invest in the structural change now, we might be in a worse position than afterwards. So we cannot hope for just a simple rebound by doing nothing else than budget control.
Okay. And just I see we've got 5 minutes, just to really wrap up, Daniel, a couple of questions. Is the winter of discontent now, or do you see this being more next year?
It's a long winter. I think the real discontent will be in Q1 2023. By the way, we shouldn't forget we have the World Cup in Q4.
We do.
Usually it's a cyclical driver. Think of Olympics, World Cup, elections are typically cyclical drivers, but more so in the US and in Europe. We've seen actually limited net benefit from sporting events on ad spend. And I think in Q4, the timing with the Christmas business already, then it being in an unusual location, it's not helping. It's not helping ad budgets.
Okay, and just we're obviously going to be doing another one of these State of the Nations in the next quarter, so that we can go back and see if you're going to do a U-turn on your predictions, Daniel. But looking back at that initial data that you have at the last recessions, we have to also be mindful that a lot of today's media planners may not have even been born in that last recession. We are in a completely different makeup now with programmatic, the ease of trading. Do those factors you went through and looked at, how you forecast and the different things, but we are a different industry now, and people don't remember kind of what happened before. Do you think that it may not be as bad as you have forecasted? And actually, you kind of said it a few minutes ago that brands may actually be looking to spend their way out of this. So maybe we're not going to have that knock-on effect that previously happened.
It's often, let's exclude SMEs for a moment, but who is in charge of ad budgets? It's not the CMO, it's the accountant, it's the procurement director. And those are usually not of that Gen Z generation. They are more established in their careers. They look at models, they look at long-term trends, they look at time series. So we cannot rely on youth here to change how the relationship between advertising and the economy works. Having said that, let's see whether in some of the in terms of the D2C brands and others, there is going to be a different approach. However, reminder, with all the venture-backed companies, it's about profitability. It's not about growth at all costs. So I would be careful of being of relying on our younger colleagues to change the course of this looming ad recession.
Amazing. All right, Daniel. Well, on that note, thank you so much for today. And as I said, we will be back with our State of the Nation next quarter to see indeed if Daniel is going to be doing any U-turns on any of his stats or predictions. But please do, I've a couple of questions about, will we be sharing this deck? Absolutely. If you've turned up today, even if you didn't, we've got the recording that will be up on our website, and the slides will be emailed to you so that you've got a copy of those, and you can hold Daniel to account next quarter on those stats. All right. Thank you very much, everyone. And we look forward to welcoming you soon.